Hi, it's Lee, and welcome to Tesla Economist. As you know, I've never laughed or mocked at any bears about what they've said in the past about Tesla. I've merely entertained them and wanted to hear them out and make sure we're not in an echo chamber and make sure we're not being arrogant about how much cleverer we are either or investing with hubris. But I would like to entertain the fact that Tesla may actually be losing demand. I know a lot of you want to blame Elon for the stock price dropping, but the fact is that it's mainly the economy to blame for the majority of our loss. Interest rates have been increased massively, especially proportionately to where they were previously. It simply makes financing a car that much more expensive. Equally, the opportunity cost of keeping your money in the bank rather than buying a car is higher. And then, of course, the return on investment of interest in the bank is outweighing investing in the stock market, hence why stocks are dropping so much too. We're seeing other auto companies dropping massively as well, but not as much as Tesla, perhaps because a lot of Tesla's stock price had growth priced in too, which is much harder to expect when in a recession, or with a higher cost of money. I mean, obviously demand is down for Tesla due to this, but is it down as much as people are saying, and as much as is actually priced into the stock? Tesla are really offering some major incentives for their cars right now, until the end of the year. It was understandable if it was just in the US, as there'll be a massive discount from next year anyway. But offering incentives in a lot of other markets doesn't follow that same narrative. Yes, I do think Tesla are doing a big push this quarter for the end of the year, but it's possible demand is down a lot as well. These are some big discounts we're seeing, but why offer a $7,500 discount in the US when that discount comes in next month anyway, or equivalent of? That's a lot of margin eaten up, which is why you'd think it might be a push. Although even if deliveries hit something like 450,000 for the quarter, it may not do what we hope for the stock price anymore. The sentiment may have changed. The market is forward-looking and wants to know what next year will be like, rather than last quarter. Likewise, I don't think a buyback would do much for the stock price right now either. I doubt it would do what investors are hoping. Even Elon saying he'll step down as CEO from Twitter isn't having any effect on the stock, implying that perhaps Twitter didn't affect it as much as some think in the first place. Although a lot of investors would like Elon to address these potential concerns that I am raising too. That saying, "it's the economy, stupid," feels like it's ringing true. Yes, Tesla down significantly more than the broad market, just like it was up significantly more than the broad market before. The Tesla dream has gone from the market, or at least for now, as a reality sets in to see what the intrinsic value of Tesla is as it holds through a recession. Now, if Tesla's demand is down in other markets that don't have the tax credits coming next year, then perhaps Tesla will need to drop their prices during this period. This is one of the buffers they have. We have known this for some time, hence why we thought Tesla was a safer investment that would be able to cope through the tougher times, whilst others have a real chance of facing bankruptcy. Each time Tesla drop the price of their cars, they become relatively cheaper when compared to ICE, which do not have the luxury of price drops. Tesla's pricing and all EVs have more elastic demand due to all the cost savings of an EV. They enter a much larger pocket of demand. However, as there is no competition, Tesla also keep all the demand of the previous price point too. Don't forget why you invested in Tesla. If it's this bad for Tesla, then how much worse is it for the competition? Tesla has the best chance of surviving a recession better than any other company. Yes, even BYD, as BYD barely have profits in their BEV business, and may even lose their subsidies for EVs next year. They may have spread themselves too thin, and are about to discover why companies need to make profits before they can expand to insane levels of production. A company like Rivian probably has enough capital to get through due to how insane their IPO was, but still need to eventually make a profit. The other Chinese EV companies are in big trouble as they all lose money, and if they have to drop prices or cut production, the losses will be that much worse, meaning their 2 years left of capital until bankruptcy won't even last that long. It sounds like Tesla may have cut production by 30% in China, but that only means we're back to where we were before the ramp. Tesla can export the majority of their made-in-China vehicles anyway. There's still a lot of international demand for these lower-cost Teslas. Yet it's not great if production is down that much, but it's not as bad as the stock price is saying. Of course, the competition I'm really referring to is legacy autos. With the insane levels of debt already, they've been flying far too close to the sun. They can't lower their prices to increase demand as they don't have the margin buffer. They have to cut back on supply, close down factories, lay off workers, and moves like that is what causes a real recession. They will need a bailout. The thing is, Tesla still very much is a growth company and is no longer priced like one. And even if demand is down, Tesla's growth was going to come from vehicles that cost less to produce, implying even more buffer in price, and thus potential to restore demand. Remember, people still buy cars in a recession, and the competition can't reduce their prices. Tesla will have higher margins with their newer models. Tesla may take down the Model 3 lines and start to make the lower cost Model 3 Highland, along with the 4680 Model Y, which has massive cost savings. Tesla have found lower cost, more efficient ways of making EVs, and we haven't even seen them in the market yet. Tesla have found lower cost, more efficient ways of making EVs, and we haven't even seen them come to the market yet. The demand in the US is hopefully supported with this tax credit, and even if it isn't, Tesla still have huge margins in the US due to such massive price rises that we've seen over the last year or so. If Tesla dropped their price by 24% for the Model Y long range in the US, then that would mean that the price becomes $50,000. Might I remind you, that was the price of a Model Y long range back in February 2021, and the stock price was still $285 back then. The Model Y still costs 32% more now than then, and the stock price is less than half. And there was no news of any subsidies or credits coming. Elon's even saying that he is seeing deflation, which would imply the cost of goods sold are going to also come down, which would mean margins are going to increase. And now it sounds like we don't even need to solely depend on car sales anymore, with energy finally starting to do its thing, and potentially $9 billion in gross profit that might come in from there next year. The main buffers we had for demand for Tesla were the waiting times, the margins, and advertising. Tesla could start advertising on Twitter, although it may not look good for the shareholders if they're suddenly paying, so perhaps Elon might give Tesla a massive discount. But still, Tesla could advertise about the tax credit or other cost savings of a Tesla, or other features or safety. Reserve banks are putting on the squeeze. It can't last forever. Something will break, and they will have to eventually pivot. Obviously, these are not sustainable levels of interest to maintain. Governments want to protect their currencies. They printed too much, and they don't want them to inflate. But they're reducing inflation by cooling down the economy and reducing the velocity that money circulates through the economy. It will not, however, change the fact there is still that many more dollars in the world. Anyway, this is the whole point we make about being long-term investors, and you'll have to go through a downtime. We just hoped that Tesla would have been more ready with 4680 sales and Texas Model Ys, so the company profits could have grown into the stock price. Of course, if that had happened, then the stock would have jumped to $600 or $700 and would still be back down to $200 or $300, and people would have still bought at the highs. We do have the Cybertruck though, which still has a lot of demand, and I've been saying for some time, when Cybertruck is in volume production, that is a pivotal point of the company. Where the stock price will be then will come down to the economy and the PE ratio the market decides as a result. But we've done the numbers. If everything does go well, we would be at a PE ratio of 10 to 15 based on today's stock price. So make of that what you wish. I'll try and throw some numbers together to see what the financials would look like if Tesla did reduce prices in order to meet drop demand. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.